This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. I'm your host, Justin Goodbread, and today we're still in our deep dive of building a best-in-class finance department for maximum value growth. Today's episode is titled, How to Make Your P&L Tell a Story. So I review in excess of 100 profit and loss statements per year. So P&L stands for profit and loss, and it's a simple document that most accounting softwares will produce. In fact, I'm not aware of any accounting software that does not produce a profit or loss statement. And what it's reflecting for you is the amount of incomes versus the amount of expenses to get some idea on what the net earnings of the company are going to be. And the reason why I say it's some idea is because there's a few things that are often not categorized or not accounted for on the P&L. But at least gives you some idea. And then whenever you close the books out and you get ready to finalize your taxes, and those items will often be brought into the profit and loss statement. But for many business owners, a profit and loss statement is no more than just a past wake, if you will. You know, whenever I take the boat out to the lake during the summertime here in East Tennessee, we love to pull the kids on tubes. And candidly, I love to go on the tubes with them and see if I can throw them off. I mean, what daddy doesn't like trying to throw the kids off the tube, right? So I like to get on there. And as we're being pulled behind the boat throws a wake out. A wake being waves in the prop, creates some prop wash, and it creates a trail through the smooth Tennessee mountain waters. And we can look back from where we've been and see exactly where we have been. And that's okay. In fact, as you're out there on the lake, you can turn around and you can see where other boats had just cleared. And oftentimes that's helpful whenever the river system has a lot of debris in it. You can see where boats have already gone. Assumingly, there won't be any debris in the way. Well, for many business owners, a profit and loss statement is often no more than that wake. Yeah, we've been there, but it really doesn't matter. We're paying attention where we're going. And friends, that is a harmful mentality. So in the next few episodes, I'm going to deal with how to make your P&L tell a story, number one. Then we're going to deal with budgeting, zero-based budgeting versus year-over-year budgeting. And then we're going to get to the point of how to build a pro forma. Because all three of these episodes, these next three episodes, come from the data that your accounting department should be categorizing for you in a profit and loss. So let's lay the basics out first of the profit and loss. In the first part of the report, if you have one, if you've seen one, it's going to lay out the revenue, the total revenue that was produced by the organization. Now, some profit and loss will give you a 1 month snapshot. Some P&Ls will provide you a month over month. So I'm looking at an example in front of me here that goes from January through December, and it shows you the different revenue streams that have been produced per month. And then some revenue streams or some profit and loss will only provide you a year end or quarter end or a month end. So you can run different time frames, but nonetheless, at the top, you're going to have your revenue stream. The second thing typically on a profit and loss is the area that deals with the cost of goods sold, the cost of goods. For many companies that I work with, they are resellers of goods. So for example, I have clients who get a widget from one particular organization, and they use that widget in manufacturing another product or another service. I have a pool builder, for example. I was just talking to him on the phone a while ago, and the pool builder orders concrete, lots of pipe, lots of rebar. Well, those expenses for those particular items will go into the cost of goods sold. I have some clients that their accountants like to put certain types of labor in the cost of goods because of the way they account for it within their matrix of their softwares. So in the first area, you're going to have accounting, your income. Then you're going to have your cost of good, which is your very first expense. And then that's going to give you what people often refer to as gross profit. So the way you come up with gross profit is you have total revenue minus cost of goods gives you gross profit. And then you're going to have the business expenses. And the business expenses are the ones that you and I are used to dealing with on a regular basis. And they may be advertising or insurance and maintenance, rent or office space or office supplies, salaries. Ooh, that's often the largest single item on any profit and loss statement in the expense category is the salaries and wages. Technology, utilities, and there could be a number of expenses there. So you're going to have your expenses. So from the top bottom, as we review, you start off with your revenue, and that gives you your total net revenue. Then you're going to have your cost of goods, which once you subtract your cost of goods from your total net revenue, then you're going to have gross profit. Then you have your expenses. And so what you would do is you would take your gross profit and subtract the total number of expenses, and that would give you your earnings before interest and tax. Then you may include your interest expenses and you may include your income taxes depending on the type of profit and loss you're running. Many times, profit and loss from certain software companies don't include interest expense, and many times they don't include income taxes. Income taxes being on the individual level or the corporate level. Now, sometimes they do. Sometimes they do. I was looking today at 3 or 4 P&Ls in reference to this particular day, and I was noticing that the S corporations did not include the individual flow-through taxes, which they never do. And the partnerships don't include the individual flow-through taxes, and they never do. But the C corporations had the income taxes due by the corporation because it was an expense. So I just think that's interesting. So after you do all the subtractions, you come down to the very bottom number, which is your net income, or net earnings is another term that people will use. And that is your typical profit and loss statement. It's taught in accounting schools and basically accounting 101. I mean, it's super easy. I learned how to read a profit and loss statement when I was 15 years old. So they've not changed much. But my theory with profit and losses is the reason why us entrepreneurs often don't understand them is because we don't know how to make them readable to us. We don't know how to break them down so we can understand what we're looking at. So I'm going to give you some tips today in each of those categories that may help you define or build your profit and loss so that you can use it for growth and you can use it to go through the next budgeting episode that we're going to talk through and ultimately the forecasting episode that we're going to go talk through.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
So let's start with the income. One of the things that I typically ask customers or clients to do is to tear apart their income stream and look at the major areas of their income. So, for example, in the financial planning world, we have about 5 different types of income, 5 different ways we get paid. They're all fees because we charge a fee, but nonetheless, I have 5 or 6 different types of fees that are paid to us. I have, as I mentioned earlier, this shop. They have revenue that comes from car repairs. They have revenue that comes from oil changes. They have revenues that comes from car cleanings. They have revenue that comes from wrecker services. They have revenue which flows ultimately in from maintenance. I mean, there's a number of different revenues you can track. If I mention the pool builder again, they have revenue that flows from construction of building new pools, from maintenance of repairing pools, and from chemical maintenance or ongoing maintenance. They have a number of different types of revenues. And so my challenge to you, whenever you look at your revenue, your top line income section of your profit and loss, separate out the way to which you are paid by the various revenues. You say, well, Justin, why does that matter? Well, when it comes time to value your company, there may be certain revenues which will add a greater factor or a greater multiple for you. And therefore, you want to focus on those particular revenue factors. So, for example, in the financial world, I'm going to talk about the global financial world in this particular example. The financial world is often comprised of people who will sell commissionable products. Annuities, which they drive me crazy. Very high dollar commission life insurance, like whole life insurance products. And we'll talk about those in an episode eventually. But they'll sell these things. And with those commission style products, the company will receive a very large lump sum payment. Well, whenever I'm looking at those payments, that is a revenue stream which is hard to duplicate. It's hard to count on it from a recurring revenue standpoint. And thus, it doesn't receive the same factor in a sale of a business as perhaps a annual fee from a group of clients who have paid it consistently for 7 or 8 years, who sees value in what you're delivering. And that annual fee would have a recurring revenue model, and therefore it would provide a greater factor, a greater multiple when it comes time to sell the business. So when you build your profit and loss statement to where you can see the various types of revenue, it allows you to track the various divisions, if you will, departments, the debt revenue streams in your organization, and therefore able to isolate the strengths of your revenue stream and forecast eventually what your business will be worth. So that's the first thing I would challenge you to do. The second thing I would challenge you to do is break out your cost of goods sold. So many times I see accountants who take a very lazy approach to just lumping all the cost of goods sold into one particular area. Now, let's go back to my pool builder client. If we isolate out the amount of concrete that we purchase in a given year from the various concrete suppliers, and we isolate the various pipe that we would use for the piping, and we isolate the rebar that we would use for the rebar work. If we isolate those things and we see a trend, then it gives us a negotiating power whenever we go to the suppliers to negotiate for price breaks, because we can show a trend on here's how much we have historically ordered from our total providers. Would you be our one and only if you could cut your prices down, thus creating more margin? You see, without having the ability to segregate and track that, you lose the negotiating power when it comes to cost of goods. That's just one example. So my challenge to you is, at this point, is to go and look at your cost of goods and break out your major areas, the major areas of those that you see within your particular enterprise. Now, in the expense section, this is where many people focus on because it includes the things which are discretionary and the things which are mandatory or required. So there are going to be items within the expense section that you really don't have a choice in. You have a contract maybe. So for example, rent. Perhaps you signed a 10-year lease agreement and you're required to pay that rental price each and every month. Well, that's going to be a required expense. There's not any discretion on that. You're also going to have things like insurances, which are going to be required expenses. But then you're going to have various discretionary expenses. Discretionary expenses could be as simple as advertising, which, candidly, I really wish advertising was a required expense, but unfortunately it's not. I think it should be because so many small businesses don't utilize it properly. But nonetheless, it's a discretionary. Travel could be a discretionary. Paying for certain insurance could be discretionary. Office supplies. Every one of these items can be a discretionary expense. The reason why I want you to think in terms of required versus discretionary is because when it comes time for us to start cutting our expenses, there's only a handful of places that you can cut. And we're going to dig further into that when we start talking about our budgeting items next episode. So for this point, though, I want you to think about and highlight in your mind the areas and identify which of those are required and discretionary. And by doing so, what you've been able to do is you've been able to look at where am I spending money that I have control over, or what are my current required expenses that I can potentially create a game plan to reduce systematically over the next year, 2 years, 5 years, 10 years. And thus creating more net earnings, more margin for us. So I use that word margin now 3 times. Let me explain where that comes from. In effect, what you do is you find the percentage between your total revenue and ultimately your net earnings. And so let's say that someone's producing $100,000 and that net earnings is $25,000. In effect, that's a 25% profit margin. That's kind of how that works. Now, I've just overly simplified it. And my finance friends who went through years and years of college are saying, Justin, that is overly simplified. And you just butchered that. But nonetheless, I'm trying to keep things financially simple here, folks. So that's when I say margin. I'm looking at the percentage rate between the net earnings and the total revenue. So if you would build your P&L in a facet to where it can tell a story, then in our next episode, we're going to talk about how you can tell that story. So guys, I'm going to wrap it up with that particular summary today or that particular dialogue. Hey, look, I have a ton of people who are asking me good questions on Twitter, on Facebook. I even had somebody reach out on Instagram. They saw my little puppy dog. I shouldn't say he's little. He's about 120 pounds now. He's an old English Mastiff. And someone asked me a question. They saw the picture of him and said, hey, Justin, I was listening to your podcast. What do you think about this? I was like, dude, that's cool. You saw my dog and asked me a question about business. If that's you, hey, just reach out to me. Let me know you're here. Listen to the podcast. Shoot me a thumbs up. Our audience base in the podcast is unbelievable for our first year. We're almost to the point we're going to wrap through our very first year since we released this podcast. And it is amazing to see the number of people and hear the stories of how some of these simple examples and not so simple examples have already impacted your lives. Hey, send me a note and say, hey, brother, I appreciate it. Here's what's helped. I'd like to read a couple of those on the air. So if you send me something, I'd just like to share it with the other listeners on something that you liked. Guys, with that said, I'm going to wrap it up and say, I know I say it every week, but it's true. Life is hard. Life is good, and life can be frustrating. It can be. Money doesn't have to be. Let's continue to make our lives at least financially simple. Y'all go out and make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.